So, Marc, there's been growth in the private markets, substantial growth, I would say. What is the fundamental cause of that? Is it because of regulation in the wake of the great financial crisis, or is it larger factors?
I think it's larger factors. If you look over time, we had 8,000 plus public companies in the US. We now have just over 4,000 public companies. We should logically expect, therefore, to be more in the private markets. And I don't think people actually appreciate the scale. And this is not just US, but it's US and Europe. 80% of companies over 100 million in revenue are private. 80% of employment, private. Why would we not expect a growth in the private marketplace?
So why is it a better mousetrap? I mean, fundamentally, I think about banks as being intermediaries, sort of between people putting capital up and people needing capital. Why is private a better intermediary than the big banks?
So let's work in reverse. What are the needs for financing today? We're financing infrastructure, long term. We're financing energy transition, really long term. We're financing the new economy, data centers, power, really long term. Long term financing needs. What do banks do well? Banks borrow short and lend long. They are not ideally situated to be investors in long term assets. And so regulators, when they look at the funding for the economy, they only have two choices: the banking system or the investment marketplace. Increasingly, since 2008, regulators have chosen the investment marketplace to provide financing. Now you come to the investment marketplace, and you have two more choices. You have daily liquid funds, or you have long-term investors who are trying to match long-term liabilities and long-term assets. I think the choice is obvious. Do we really want to create more instability in our public markets by matching long-term financing needs with short-term daily liquid funds? I don't think so. We are watching the logical outgrowth of changes that started in 2008, that accelerated through a zero-rate environment, that were exacerbated by COVID, that were then refreshed by SVB and FRB. And this is not just happening in the US, it's happening everywhere in the world. Regulators are looking at the choice of how they fund their economy, and they're choosing investors over banks. That doesn't mean banks shrink. It just means on the margin, the growth is going to the investment marketplace.
Are there some things that public markets do better than private markets? You've described some of the things private does better than public. Are there some things that public really does better?
Look, we have in the US in particular, a focus on daily liquidity. If you want something that is daily liquid, if you want pricing every single day, you can only accomplish that in public markets. Private markets are not going to give you daily pricing. They can give you an indication of pricing, nor are they going to give you immediate liquidity. So if you want something that's immediately liquid, you're talking about the public marketplace. If you want access to vast amount of capital today, because that's where the capital is, you're talking about the public marketplace. But if you're talking about matching long-term capital needs, you're really talking about the private marketplace.
When you talk about daily pricing, some people hear transparency. That is to say, you have transparency in the public markets and not in the private markets. Is that right?
I don't really think so. So let's start in the fixed income market. You own a public bond. Can you sell that public bond? Maybe. On average, it takes about 5 days to sell an investment grade public bond today. When you see a price or a quote, that's for a very small subset of the bond market. In the private market, can you sell your bond? Yes. On average, probably takes you about 5 days to sell your bond. What we're watching as private markets get bigger, we're actually watching increased liquidity in private markets. It's not to say it's the same as public markets, it's not. But this notion of transparency is actually itself an interesting thing. Are private markets not transparent? This is the argument that regulators make. They talk about private credit as a threat to the system. Well, every dollar that moves out of our US banking system makes the system more resilient. Banks are levered 10 to 12 times. Investors, zero leverage. Mutual funds, zero leverage. BDCs, 1.5 times leverage. Retirement services companies, 8 times leverage. Everything that moves out of the banking system deleverages. Transparency. Banks, loans to customers, loans to companies. In our portfolio, every security every quarter. Maybe regulators are not looking in the right place. And then you look at quality. The typical bank is about 65% investment grade. You look at our balance sheet, 90+% investment grade. You just keep going down the list of factors. Banks do maturity transformation. We and most institutional investors do no maturity transformation. We match assets and liabilities, creating inherent stability. No access to deposits, no access to government guarantee. So why are we against private? Well, we're against private because we have some vague notion, going back 40 years, that public is safe and private is risky. I actually think what we're doing as a society, financial markets particularly, we're actually revisiting that fundamental premise.
Well, let's talk about the fundamental premise. You talked about regulators a couple of times. You go back to 1930s, when originally we had the 33 Act, the 34 Act, Investment Company Act. The theory, I think, was in part, we need to have public markets to public disclosure everyone has access to. It was reformed again in the 60s, actually. Regulators right now are saying there's a problem with the private markets. We don't have that kind of look into what's going on. Are they right?
I don't think so. The other thing that happened when we go back and look at our securities laws, we divided our market into individual investors and institutional investors. Institutional investors have been invested in private markets for a really long time. It's just that if you think about the typical institution, 50% allocated to public equities, 30% allocated to public fixed income, 20% in their so-called private or alternative bucket. Why is that bucket so small? Well, it's small because private was risky, and the public is big because it was safe. This is what I'm talking about revisiting. Go back when I started. I'm 40 years in the business. There were 3 products in the private market: private equity, venture capital, and hedge funds. All 3 amazing investments, but risky. Now I look at the private markets. Private markets go from AA bonds to levered and venture equity. Safe and risky. Now I look at public markets. Also go safe and risky. We're now talking about differing degrees of liquidity rather than risky and non-risky.
So it sounds like one way of looking at what you're saying is the diversification of the private markets itself has made it less risky, has given it some stability.
It is not only less risky, it depends on the product. Public markets are not inherently safe. Private markets are not inherently risky. It is the underlying product. And so what we're watching is a rethink of how assets are allocated by institutions. And so they've always allocated, institutions are the easiest place to start because they are the sophisticated investors here. They've always had access to private markets for their alternative bucket. Increasingly, what we're watching investors take their fixed income bucket and split it between public and private. Why is it happening in fixed income first? Because there are external gatekeepers, signposts, rating agencies, who tell institutions, this is an A and this is an A. Is a single A rated private security an alternative or fixed income? I think it's pretty clear it's fixed income. And if you're an investor who has a 20 or 30 or 40 year time horizon, and you can earn 150 or 200 basis points more in the private market and get more diversification, isn't that a better alternative for at least a portion of your portfolio? So I look at our firm and our industry. We're a little industry and a little firm in the scheme of the investment market. We've built a business and a whole industry out of that little alternative bucket. All of a sudden, the fixed income bucket is open to us, and it's even larger than the alternative bucket. And eventually, I believe we will also have access to the equity bucket. Because if you used to invest in 8,000 public companies and now it's 4,000 public companies, but you're really invested in the S&P through index funds, so 10 companies are 35% of the index, and you're invested in NVIDIA, Apple, and Amazon. You see where concentration and indexation and passive investment have changed the nature of equity investing.
So we've been talking about structural changes within the financial industry, actually, that have made private markets evolve. What about larger forces, what we're looking at right now? We've gone through a period of extraordinarily low interest rates, a lot of liquidity, as the United States and other places have pumped a lot of money into the system for good and sufficient reason. We had a pandemic, we had a great financial crisis. As that tightens up, as I assume it will, how does that change the equation for private?
It is absolutely the driving force. I mean, this is focusing on the urgent, which is what we were talking about before we came on air, versus the important. This is the important thing that's happening in our business. At our recent partners offsite, I put up a slide that said in 2008, Apollo, 40 billion of AUM. 2023, 650 billion of AUM. We grew 14 times. We outgrew Apple. We outgrew Amazon. We outgrew Microsoft. Pretty impressive stat. Next slide. Were we lucky or smart? We were lucky. You can't possibly plan on growing your business 14 times, but you can position the business in a way that you take advantage of powerful tailwinds or trends. What were the tailwinds? 2008, we had a financial crisis which pushed most financial institutions in the Western world on defense. We built and formed a financial institution called Athene in 2008. That company went from a startup to today, $360 billion. Offense. Could never have been done but for the macro environment. The other thing that happened is rates went to zero. People who had made promises to retirees, to pensioners, and had other obligations that were fixed, all of a sudden needed to look elsewhere for rate of return. They were willing to consider that perhaps private markets offer an alternative. Okay, those tailwinds powered us through 2008. Now I sit in 2024 and I say, what are the tailwinds? This tailwind of debanking, of having investors do more and banks do less, absolutely happening and happening everywhere in the world. Does not mean banks will shrink. It just means on the margin, growth is going to come in the investment marketplace, not in the banking marketplace. Second, retirement. Unfortunately, we're getting older. Every Western society is getting older. We as societies have done a terrible job with guaranteed lifetime income. Everyone will need more guaranteed lifetime income. This is a fixed income product. It is powered by highly rated fixed income, so-called private investment grade. Big growth market. High net worth. Institutional investors used to be the dominant forces in our industry. We're at the very beginning of high net worth investors exploring private markets. This is going to a trend that's going to take place for the next 20 years. And finally, indexation and commoditization of markets. If you're an active manager of equity, you've failed to beat the market better than 90% of the time for 20 years. I don't think you got stupider. I think these firms are actually really good, but the structure of markets changed. And this gets to the notion of if 4,000 public companies is not enough for diversification, you're going to have to find a way to participate in private markets. All four trends power not just Apollo, but our industry.
When we talk about pensioners or retirees, there's a big looming problem, obviously. As people advance in age, they need retirement income. Is private part of the solution to that problem? Are you going to help us get out of this jam?
It's a part of the solution. So we have an actual experiment. We can look at Australia. 40 plus years ago, Australia adopted superannuation, which sounds like a fancy solution, but what is it? It literally just gave normal investors who needed returns access to private markets through supervised supervision. And Australia has been the most successful retirement investment market anywhere in the world. What do we do in the US? Yes, we have defined benefit plans, but defined benefit plans are shrinking, not growing. Most of our retirement money is in 401k, 12 to 13 trillion by some estimates. What are these people invested in? They're invested in daily liquid funds for 50 years. Why are they invested in daily liquid fund for 50 years? Well, because public was safe and private was risky. It will not surprise me, and we're already seeing the beginnings of it. Retirees who are thinking in 20 and 30 and 40-year timeframes, having access to private markets. That doesn't mean private equity. That doesn't mean venture capital or hedge funds. That means the whole swath of the economy that is just not publicly listed.
So, Marc, let me shift to a different subject here. You started out as a media banker, I think.
Unbelievable. Hard to know.
You talk about disruption. I mean, having spent some time in media, including on the business side, there's a huge disruption in media right now. Can you compare what we're seeing that shifts, the fundamental shifts in media, with what we're seeing in the move to private from public? Is it a similar sort of fundamental shifting of the ground under us?
I do. I think there's a wholesale rewiring. If you think about where people used to spend their time in media and how they consume media, I joke with my kids who are somewhat older this time. What do the numbers 2, 4, 5, 7, 9, 11, and 13 mean? They look at me like they must be prime numbers or something like that. I'm like, no, they're channels. That's how people used to consume media. We had a time. We watched something at a time. All bets are off, not only in terms of how media is delivered, but how it's created, the ease with which it's created, and so on and so on. Financial services, we are going through that same sort of revolution in a much more regulated business. So it will not happen as fast. It is not just about public and private markets. It's about security. It's about who provides our services. We have a whole group of tech companies who are encroaching on the turf of the banking system. We have banks who are living in a more regulated paradigm, but are nonetheless the key gatekeepers to services. So I look at our industry. What is our job and our job at Apollo? Our job is to match long-term liabilities and long-term assets to provide rate of return to investors, excess return per unit of risk. What is our job not to do? Well, we're not actually the competitor of the banks. We don't want their customer. We don't want to provide them advice, equity, M&A, hedging, derivatives, foreign exchange, payments, or credit cards. I think the banking system, particularly the regional banking system, is going to look very different. The big banks, lots of advantages. The regional banks, higher funding costs, higher regulatory costs, higher technology costs, and answering really fundamental questions like, are deposits sticky? Well, they used to be sticky. You and I, unfortunately, remember that there used to be something called a passbook, which no one else will know what that is. Now we just swipe right and our money moves. In that era, are SVB and FRB isolated incidents, or are they simply the beginning of the evidence of what the system looks like when money moves at a touch of a fingertip?